So, in the last 90 days, Wendy's insiders bought nearly 3 million shares of their own stock,
Right. And not a single insider sold.
which is, pretty shocking because if you look at their actual business right now, or in August of 2026, their same store sales are just tanking.
Oh, absolutely. They've been forced to close hundreds of locations.
Yeah, and they're carrying so much debt that credit agencies are actually issuing warnings. So today, we're doing a deep dive into the current state of Wendy's. Ticker symbol WN.
It's a really fascinating situation.
It is. Our mission here for you, the listener, is to figure out what exactly these insiders know that the rest of Wall Street just doesn't.
Right. Because you really have to ask, are we looking at a fast food empire in a structural death spiral?
Or is this the early stage of, like, a massive, heavily engineered turnaround? To me, it feels like buying this shiny new car off the lot only to get it home and realize the engine is entirely held together by duct tape.
That's a great way to put it. It's arguably the most fascinating tension in the market right now. The sources present us with this high-stakes collision.
Yeah.
On one side, you have these rapidly deteriorating fundamental metrics at the operational level.
Just really ugly numbers.
Exactly. But then on the other side, you have this empirical, undeniable bullish signal from the very people running the company.
Right, the insiders.
Yeah. So to understand the stock's recent volatility, we really have to isolate those two forces. And I think we need to start with the actual day-to-day operations of, just selling burgers.
Okay, let's unpack this. Because when you look at those operations, the Q1 2026 earnings report is basically a masterclass in why you can never trust headline revenue number.
Oh, for sure. On the surface, it looked okay.
Right. They reported a revenue increase of 3.3%, hitting $540.6 million. If you just skimmed the press release, you'd think, hey, they're capturing market share.
But you have to look under the hood.
Exactly. Beneath that top-line number, net income plummeted by over 42%.
Wow. Yeah, that's massive.
And U.S. same-restaurant sales actually fell 7.8% year over year. Global system-wide sales declined 5.5%. I mean, the core engine is just sputtering.
Which brings us to the most critical operational metric in the entire quick-service restaurant industry, the company-operated restaurant margin.
Right.
In Q1, Wendy's margin compressed dramatically. It went from 14.8% down to 11.4%.
That is a 340 basis point drop. In a business that's built on, like, extreme volume, that's an operational earthquake.
It really is. The quick service model is just highly sensitive to operating leverage.
Because of the fixed overhead, right?
Exactly. A drive-through has heavy fixed overhead.
Mm-hmm.
So every incremental dollar of sales above your break-even point is incredibly profitable.
But it works the other way, too.
Yep. Every dollar lost below that point destroys your margins exponentially.
So what exactly is driving that 340 basis point drop? I know the sources point to severe winter weather in January and February.
Right, which always hurts foot traffic.
And there's a broader consumer pullback, obviously. But there's a third, much more deliberate factor here, which I found wild. Management is intentionally reducing operating hours across the system.
Yes. They're calling it Project Fresh.
Wait, they are intentionally reducing hours. How does making it harder for customers to buy burgers actually help the bottom line?
Well, this is where we see management actively trying to stop the bleeding.
Okay.
When inflation pushes your variable costs higher, specifically hourly labor and food supplies, certain operating hours become structurally toxic to the bottom line.
Ah.
I see. So if a location is paying a full crew to staff the graveyard shift, say from midnight to 2 a.m., but the drive-through traffic is totally dried up because consumers are tightening their belts.
Then that location is basically paying for the privilege of being open.
Exactly. So Project Fresh involves this severe footprint optimization. They are ruthlessly cutting those unprofitable hours.
I mean, I look at the mechanics of Project Fresh, and while cutting unprofitable hours makes mathematical sense on a spreadsheet, to cap variable costs,
Right.
I really have to question the long-term strategic wisdom here.
How so?
Well, if you start closing at 10 p.m. instead of midnight, don't you just invite your late-night customers to drive across the street to McDonald's or Taco Bell?
You do?
So how do you prevent that temporary optimization from becoming permanent customer churn?
That is the exact risk management is taking.
Mm-hmm.
And I think it shows you just how defensive their posture has become right now.
Like they don't have a choice.
Right. They are willing to sacrifice top-line market share and risk habitual churn just to protect what little margin they have left.
Wow.
It's a triage maneuver. You don't worry about physical therapy when the patient is actively bleeding out on the table. you know?
That's a grim analogy, but yeah.
They are shrinking the operational footprint just to save the profit margin.
But the irony here is that even as they shrink the footprint to save cash at the store level, that cash is immediately being devoured by a balance sheet that looks increasingly
Oh,
precarious.
the debt profile.
Yeah. If you're holding this stock, the debt is where the tension really escalates. S&P Global Ratings just recently revised Wendy's outlook to negative.
While affirming a B+ rating.
Right. And we should probably contextualize that B+ rating for you guys.
Yeah, that puts Wendy's firmly in non-investment grade territory.
Junk status.
Exactly. The market colloquially refers to this as junk.
Uh-huh.
So the shift to a negative outlook means the credit rating agency sees a high probability of a further downgrade if things don't stabilize,
And a downgrade means higher borrowing costs.
which further compresses cash flow in this vicious cycle.
And the numbers completely back up S&P's anxiety. Wendy's adjusted leverage is projected to hit a staggering 6.8x in 2026.
Which is wild.
Keep in mind, the company's own stated maximum target for leverage is 5x.
Right. They have blown past their own guardrails.
Totally. And at the exact same time, their free cash flow dropped 46.3% to just $36.5 million in Q1.
That is a massive drop in free cash flow.
It really is. But here's the piece of the puzzle that just defies traditional logic to me. Despite a 46% drop in free cash flow, and despite blowing past their maximum leverage targets, and despite a negative outlook from S&P,
Let me guess.
Wendy's is still paying out a $107 million annual dividend.
Yeah.
If their free cash flow is tanking and their credit rating outlook is negative, why on earth are they still shelling out $107 million in dividends? Isn't that like buying first-class tickets on a sinking ship?
If we connect this to the bigger picture, it makes a twisted kind of sense. In modern public markets, cutting a dividend is the ultimate nuclear option for a mature stock.
Because of the income investors.
Exactly. Wendy's sits in hundreds of income-focused exchange-traded funds, mutual funds, and retail dividend portfolios.
Right, they hold it specifically for the yield.
Yes. If management cuts or suspends that $107 million payout, those passive funds are algorithmically mandated to sell.
Oh, wow.
You would see an immediate indiscriminate dumping of the stock that could slash its market capitalization overnight.
So management knows this, and they are essentially trapped in a yield paradox.
They're held hostage by their own shareholder base.
That's crazy. They have to keep paying the dividend to keep the stock price artificially supported, but paying the dividend starves the actual company of the cash it desperately needs to, like, deleverage the balance sheet or reinvest in the restaurants.
Exactly. And that 6.8x leverage ratio creates a secondary set of handcuffs, too.
How so?
Typically, if a company feels its stock is undervalued, they use excess cash to execute share repurchases.
Buybacks. Yeah, it reduces the share float, boosts earnings per share, and signals confidence.
Right. But as S&P explicitly noted in the sources, sitting at 6.8x leverage effectively precludes Wendy's from initiating any meaningful share repurchases.
Ah, so their financial flexibility is just paralyzed.
Totally paralyzed. They cannot defend the stock price organically, and they cannot fund internal growth without taking on even more expensive debt.
Which means the burden of survival falls squarely on the franchisees.
It does.
That corporate financial squeeze is manifesting out in the real world in a really brutal way.
The store closures.
Yeah. In the first half of 2026, approximately 300 Wendy's locations were completely shut down.
That's huge.
It represents 5 to 6% of their entire U.S. store base. Now, management's official spin on this is that it's just strategic optimization.
Natural.
But there's a dark irony here, right? For a brand whose entire identity is built on fresh, never-frozen beef, corporate is essentially putting 5% of their franchise owners in the deep freeze.
Ouch.
I mean, is strategic optimization just a sanitized way of saying these operators went broke?
It is. It's the harsh reality of the franchise business model. The mechanics of franchising inherently protect corporate at the expense of the operator.
Because of the royalty fees?
Exactly. Corporate Wendy's collects a top-line royalty fee, usually a fixed percentage of gross sales, regardless of whether the individual restaurant is actually turning a profit.
Oh, man. So the franchisee is the one absorbing the rising costs of beef, the higher minimum wages, the utility bills.
All of it. When 300 stores close in a 6-month window, it doesn't just mean corporate decided to pivot.
Right.
It means 300 independent business owners exhausted their operating capital and had to hand the keys back to the bank.
Which really speaks to the broader state of the quick service industry right now. The sources note that Jim Cramer recently called the entire fast food sector challenged.
Yeah. Consumers are heavily fatigued by fast food inflation.
But why is Wendy's taking such a disproportionate hit compared to its rivals? I mean, McDonald's and Burger King aren't closing 5% of their domestic footprint.
This comes down to the concept of a durable competitive moat.
Okay, break that down for us.
In tough macroeconomic environments, a moat is what dictates survival. McDonald's has an impenetrable moat built on unparalleled global scale, absolute pricing power, and prime real estate dominance.
Sure, they're a real estate company that sells burgers.
Exactly. And Burger King has historically utilized aggressive discounting and operational scale to weather downturns.
But
Wendy's has primarily built its moat on brand messaging, specifically the higher quality, fresh, never frozen positioning.
Right. But when inflation bites, consumer psychology shifts.
Yep.
A family trying to stretch their paycheck doesn't care about the logistics of fresh beef. They care about who has the cheapest value menu.
Exactly. When discretionary spending contracts, premium messaging loses its pricing power. You need massive scale to absorb the margin compression, and Wendy's simply lacks the scale of a McDonald's.
Got it.
That lack of a structural moat makes them uniquely vulnerable to this specific economic cycle, which accelerates those franchise bankruptcies we just discussed.
So if you're analyzing the setup, we have painted an incredibly bleak fundamental picture.
Very bleak.
A 340 basis point drop in margins, 6.8x leverage, 300 boarded up stores, a trapped dividend, and a lack of a durable competitive moat.
Not to mention the analysts.
Right. Wall Street analysts are predictably souring on the stock. Citigroup recently cut their price target down to $7.25. By all traditional financial logic, this stock should be in a total freefall.
And for a while, it was. Over a 52-week period, the stock dropped almost 20%, hitting absolute lows near $6.07.
But here is where this deep dive takes a massive left turn into the unexpected.
This is the crazy part.
It really is. Over the last 13 weeks, the stock hasn't just stabilized, it has aggressively bounced back 22%. It closed recently at $7.39.
Right.
And the driver behind this bounce is one of the most explosive signals you can find in equity markets. Here's where it gets really interesting. The sources reveal that insiders at Wendy's have bought 2,829,530 shares over the trailing 90 days.
And the composition of those buys is what makes it so statistically significant.
Yeah.
Those nearly 3 million shares were accumulated across 19 separate distinct transactions.
Okay.
And more importantly, during that exact same 90-day window, there were 0 insider sales.
19 buys,
Yeah.
0 sells, millions of shares. And the market sentiment private rank, the MSPR, is sitting at 100, which is the absolute highest possible score a stock can achieve on that specific metric.
It's unheard of.
So I have to play devil's advocate here.
Go for it.
If the fundamentals look this bad, why are the people inside the building backing up the truck to buy millions of shares? Do they know something Wall Street doesn't? Could a massive burst of insider buying just be a coordinated PR stunt by the board?
Like a fake out.
Yeah, a desperate attempt to artificially prop up sentiment and prevent the credit agencies from panicking further.
It's a fair question, but honestly, the mechanics of SEC insider trading regulations make that highly improbable.
Too much red tape.
Way too much. Insiders operate under strict compliance windows and intense regulatory scrutiny.
Okay.
But more importantly, you have to look at the psychology of the people making these trades. There is an old adage in institutional investing. An insider might sell their stock for 100 different reasons.
Like what?
They are buying a new house, paying a tax bill, or just rebalancing their portfolio.
Sure, that makes sense.
But insiders only buy for one reason. They possess a deep structural conviction that the equity is mispriced and will go up.
Because they aren't using corporate funds to buy these shares, right? They are plunking down their own personal net worth.
Precisely. 19 different executives and directors aren't going to light millions of dollars of their own cash on fire just for a corporate PR stunt.
Good point.
They are looking at the exact same terrifying 6.8x leverage ratio and the same 300 store closures that Wall Street is looking at. And yet, their response is to aggressively buy the dip.
So they see something else.
Exactly. The sources acknowledge that while the potential for a speculative short squeeze remains unconfirmed, this volume of insider buying is an undeniable empirical signal. They see a catalyst that the market is currently discounting.
Which means they are betting on a very specific turnaround blueprint. They aren't buying blindly.
Definitely not.
The insiders are banking on a master plan heavily weighted toward the second half of 2026. And the architect of this plan is their new CEO, Bob Wright. He's been brought in to execute a total strategic reset, and the entire thesis hinges on the wider rollout of Project Fresh.
The footprint optimization we talked about earlier.
Exactly. Now, we talked about how Project Fresh involves defensive moves like cutting late-night hours, but there are operational improvements in there as well.
Right.
Right now, only about 20% of franchisees have adopted the full suite of these changes. But here is the critical data point from the sources company-operated locations that did adopt Project Fresh outperformed the broader system by 310 basis points in 2025.
That 310 basis points of outperformance is the golden metric.
It's the proof of concept.
It is. It's what Bob Wright and the board are betting their own money on. Management's entire guidance for the fiscal year relies on a massive operational recovery in the second half H2.
So they're basically sacrificing the first half.
Exactly. They are systematically lowering Wall Street's expectations for the near term, essentially telegraphing that the Q2 numbers are going to be ugly.
Yeah, they are officially guiding for a mid-single-digit sales decline in Q2.
Right, but they are insisting that once the franchise base adopts Project Fresh, the back half of the year will see a violent inflection upward.
But isn't that a monumental, almost impossible ask?
How so?
Well, the entire bull case requires convincing independent franchise owners to adopt this new system. You are going to a franchisee who is bleeding cash, who just watched 3 of his buddies go bankrupt and hand their stores back to the bank.
Yeah.
And you are asking them to somehow find the capital and the willpower to implement operational changes when their margins are razor thin. How does corporate force that adoption?
Well, you can't force it. You have to sell it using that 310 basis point metric as your primary weapon.
I see.
It's a classic principal agent problem in franchising. Corporate has to sit down with these distressed operators and show them the raw math.
Look at the numbers.
Exactly. They have to say, if you adopt these operational changes, yes, it will require an upfront disruption, and yes, you might lose some late-night revenue, but your underlying margin will survive.
It sounds like an incredibly narrow path to recovery.
It is narrow, but it is a credible one if the execution is flawless.
Which makes the upcoming Q2 earnings report in August 2026 the ultimate proving ground for this stock.
Without a doubt.
Management has purposefully set the bar extremely low by guiding for that mid-single-digit decline.
And that is how the Wall Street expectations game is played.
Right.
Markets don't trade on absolute results. They trade on results relative to expectations.
So if they beat the bad news.
Exactly. If Wendy's reports a sales decline in Q2, but it's only a 2% decline instead of the feared 6% decline, institutional algorithms will view that as a massive victory.
That's wild, but it makes sense.
If they can clear that artificially lowered bar, and Bob Wright can get on the earnings call and definitively prove that franchise adoption of Project Fresh is accelerating from 20% to 40%.
The market will instantly reprice the stock.
Instantly. It will reprice to reflect the successful turnaround. That is the exact catalyst the insiders are front-running right now.
So if you're looking at this puzzle as a listener, what is the ultimate takeaway? Wendy's is currently offering a pristine example of market tension.
A total tug of war.
Yeah. On one hand, you have incredibly bearish, decaying fundamentals. 5 straight quarters of declining sales, a terrifying debt load that restricts their financial flexibility, and severe margin compression driven by a lack of a durable competitive moat.
And on the other hand,
You have massive coordinated insider confidence, a stock trading at a depressed valuation multiple, and a highly specific turnaround plan engineered by a new CEO with early proof of concept data to back it up.
given those opposing forces, I think the smartest stance synthesized from the sources is one of cautious neutrality.
Just wait and see.
Yeah, the risk and reward profiles are perfectly balanced at this exact moment, but the downside risk is severe if that Q2 earnings report fails to show the promised operational inflection point.
Because if they miss,
If H2 guidance is walked back, or if leverage slips closer to 7x, the dividend will likely be slashed and the floor will fall out from under the stock.
so the intelligent move isn't to guess which side will win.
No, it's to wait for the Q2 numbers to confirm whether this internal turnaround is actually translating to the franchise level.
Yeah.
Let the data declare the winner before you place your bet.
Absolutely. But I want to leave you with one final, broader variable to consider regarding this turnaround.
What's that?
Well, if Project Fresh relies heavily on recognizing that late-night human labor is now structurally unprofitable for a fast food franchise,
Right.
How long until the ultimate optimization isn't just about cutting hours? How long until these massive operators stop trying to salvage the midnight shift with skeleton crews and instead replace it entirely with AI drive thrusts and fully automated robotic kitchens?
Oh, wow. That is a huge thought.
If human labor margins are the fatal flaw in the legacy quick service model, we might be witnessing the very beginning of a much larger, automated reinvention of the drive-through empire.
It raises a profound question about the future of unit economics.
Mm,
The brands that survive the next decade won't just be the ones with the best marketing. They will be the ones who fundamentally re-engineer how the food is delivered.
exactly. Something to think about the next time you're idling in a drive-through lane at 11 p.m. Thanks for joining us for this deep dive into Wendy's. Keep questioning the numbers, and we'll see you next time.